April's third week. Most traders don't even know what that means. But the ones who do, they're already positioning. You lost money during the war chaos. Fine. But here's the real question. Do you know why this specific window exists? Do you know what moves during this exact week? Do you know how institutional money behaves right now? Do you even know which pairs to focus on? Do you know what's on the calendar this week that can either recover your account or destroy what's left of it? And most important, do you have an actual plan? By the end of this, you will. Every single answer. Every single piece of the puzzle. Right here. Stay with me. Let me be direct. April's third week is not a coincidence. It's not some made-up calendar theory. It's not luck. It's a convergence. Multiple forces, multiple cycles, multiple institutional behaviors, all lining up during this exact window every single year. And when war chaos has just shaken the entire market, this convergence becomes even more powerful than normal. Here is why. Tax season in the United States officially ends mid-April. April 15th is the hard deadline. What happens immediately after that deadline passes? Institutional money that was sitting, waiting, parked on the sidelines during the uncertainty, it starts moving again. Fund managers rebalance their portfolios. Fresh capital allocations get approved. Quarterly mandates kick in. Liquidity floods back into the market. You can literally see it in the charts if you go back and look at April data year after year. The third week of April is historically one of the highest liquidity re-entry windows in the entire Forex calendar. Not just a good week, one of the highest liquidity windows of the whole year. That is not a small thing. That matters enormously for recovering traders. Because here is what actually kills Forex traders during war. Not the geopolitical tension, not the news headlines, not even the volatility, the liquidity drought. When war panic hits the market, liquidity dries up instantly. Spreads widen to levels that seem criminal. Slippage becomes normal. Price moves in ways that have nothing to do with technical levels or fundamental reason. Your stop losses get hunted. Your entries get filled at terrible prices. Your setups fail for no logical reason. That is what happened to you during the Iran-US conflict. The war didn't break your strategy. The liquidity drought broke your strategy. But right now, that drought is ending. Liquidity is returning. Real liquidity. Institutional liquidity. And with that liquidity comes something you haven't seen in weeks. Real tradable setups. Clean price action. Predictable reactions at key levels. This is your window. And if you don't understand it, you will sit on the sidelines and watch the recovery happen without you. Now let me explain what actually happens inside the market during this specific window. Institutions don't trade like retail traders. They don't sit on MetaTrader watching 5-minute candles. They operate on strict cycles, quarterly cycles, monthly cycles, weekly cycles. Their mandates are time sensitive. Their allocations are scheduled. Their rebalancing happens at specific calendar points. And April's third week sits at a very precise intersection of multiple institutional cycles firing at the same time. Here is what is happening right now inside institutional desks that you cannot see, but you can understand if you know what to look for. Q1 earnings season is in full swing. Major US corporations are reporting quarterly results. These results directly impact the dollar. Strong earnings mean strong economy. Strong economy means Fed has room to keep rates elevated. Elevated rates mean dollar strength. But here is the nuance. Individual earnings reports create volatility in specific pairs. A strong tech earnings report doesn't move UR/USD the same way a strong bank earnings report does. You need to know which earnings reports matter for which currency pairs. That specificity is what separates retail guessing from professional positioning. The Federal Reserve communication cycle is also active right now. Fed officials speak multiple times per week during this period. They are managing market expectations, signaling, preparing the market for whatever comes next. Every word from a Fed official is a directional clue, not a guarantee, a clue. And the European Central Bank is responding. The Bank of England is responding. The Bank of Japan is responding. All of them managing their currencies against the dollar pressure that the war created. What does all of this create together? Direction. Real sustained direction. After weeks of chaotic sideways movement during the conflict, the market starts finding its footing again during this window. Proper trends begin forming. Clean ones. Ones you can actually analyze. Ones that respect technical levels. The war noise starts fading from price. Fundamentals start mattering again. Structure starts holding again. That is when your technical analysis becomes reliable again. That is when setups stop failing for random reasons. That is when recovery becomes mechanically possible. If you've been frustrated because nothing made sense in your charts during the conflict, that confusion is about to clear. The market is returning to rational behavior. Be ready when it does. Let me get very specific now. Not all currency pairs recover at the same speed after geopolitical chaos. Not all pairs offer the same quality of opportunity during this window. Knowing which ones to focus on is not optional. It is critical. You cannot trade everything. You should not try. Spread your attention across 12 pairs and you'll execute none of them properly. Focus creates results. Scattered attention creates losses. Here are the pairs that matter most during April's third week post-war stabilization. USD/JPY primary focus. Here is the structure. The war created massive safe haven demand. Both the US dollar and the Japanese yen are safe haven currencies. During peak conflict fear, both got bought simultaneously, which compressed the pair into a tight range. Now, as fear subsides, risk appetite returns. When risk appetite returns, traders sell the yen. They move money back into higher yielding assets and riskier currencies. USD/JPY tends to push higher during this transition. The yen weakens as the safe haven premium unwinds. Watch the 149.50 to 152.00 zone. A clear reclaim and hold of the 150.00 psychological level signals the safe haven unwind is in full effect. Euro/USD second focus. The euro got hit from two directions during the conflict. First, European proximity to Middle East energy supply chains created energy security fears. Second, European economic data was already soft before the war. As energy fears ease and institutional money returns, the euro finds buyers. Euro/USD tends to form its cleanest trends during April's third week liquidity injection. Watch the 1.0800 level. It's a critical institutional level. How price behaves around 1.0800 will tell you everything about the near-term direction. Hold above it, euro recovery is real. Reject from it, more dollar strength incoming. GBP/USD third focus. Sterling carries a unique dynamic right now. UK economic data has been mixed. Inflation pressures, growth concerns. But the war uncertainty created an outsized GBP sell-off that went beyond fundamentals. When markets overreact to geopolitical events, they create snapback opportunities. GBP/USD is a snapback candidate this week. Watch the 1.2650 area. A strong daily close above that level opens the door for a significant move toward 1.2800. AUD/USD and NZD/USD opportunity pairs. These are commodity-linked currencies. They got destroyed during the war. Risk-off environments always crush the commodity dollars. As risk appetite returns, these pairs bounce. Sometimes hard, sometimes fast. AUD/USD, watch 0.6400. NZD/USD, watch 0.5950. A reclaim of those levels with volume confirms risk appetite is genuinely returning. USD/CHF counter confirmation. The Swiss franc is another safe haven currency. Watch USD/CHF as a confirmation tool. If USD/CHF is rising, it means the franc safe haven is unwinding. That confirms broader risk appetite return and validates your long positions on the commodity pairs. These pairs, these levels, this is where the recovery opportunity lives this week. This is where most traders completely destroy their recovery before it even starts. They come back to the market with emotion. They come back with urgency. They come back with the wrong size. Either they trade the same size as before the loss, or they go bigger to try and make it back faster. Both approaches are account suicide. Let me give you the actual mathematical formula for recovery position sizing. Not theory, mathematics. Take your remaining account balance after the war losses, whatever it is. Calculate exactly 2% of that number. That is your maximum risk per trade during the entire recovery phase. Not 3%, not 5%. I'll just risk a bit more on this one because the setup looks really clean. 2%. Hard limit. Every trade. No exceptions. Here is why the math is absolute on this. At 2% risk per trade, you can lose 15 trades in a row and still have 70% of your capital remaining. 15 consecutive losses. And you're still in the game. Still recoverable. At 5% risk per trade, 15 consecutive losses wipes your account. Gone. Finished. At 10% risk per trade, 10 consecutive losses destroys the account completely. And here is the reality that most traders refuse to accept. Losing streaks happen, even to good traders, even with good strategies, even during good market conditions. During post-war recovery conditions where residual volatility still exists, a losing streak of 10 to 15 trades is not unusual. It's actually common while the market is finding its new normal. If you're at 2% risk, you survive that streak. You stay in the game. You're there when the conditions fully normalize and your strategy starts printing again. If you're at 10% risk, you're done before the real recovery even begins. 2% is not a suggestion. It is the line between surviving this recovery and blowing up completely. Now let me give you the actual position size calculations so you know exactly how to apply this. Formula: position size equals sign account balance, risk percentage, stop loss in pips pip value. Example: account balance is $5,000. 2% risk equals $100 maximum loss per trade. Stop loss is 20 pips. Pip value on EUR/USD standard lot is $10 per pip. Position size equals sign 120, 10 equals sign 100 divided 200 equals 0.5 lots. That is your maximum position size for that specific trade. Different stop loss? Recalculate. Different pair? Recalculate. Different account balance after each trade? Recalculate. Every single trade. This is not optional. This is the mechanical foundation of your recovery. The time frame you use during recovery is not a personal preference. It is a strategic decision, and most recovering traders get it completely wrong. Here is the problem. During the war volatility, traders moved to lower time frames trying to avoid overnight gap risk, 5-minute charts, 1-minute charts, constant watching, constant reacting. That behavior burned them out, confused their analysis, got them stopped out repeatedly by noise. Now in the recovery phase, they're still on those same low time frames, still reacting to noise, still getting stopped out. The time frame structure needs to change, deliberately, intentionally. Here is the exact framework for this week. The analysis time frame, daily and 4-hour. This is where you understand direction. This is where institutional money leaves footprints. Large candles, strong moves, clean bounces from key levels. On the daily chart, identify the current trend direction post-war. Is price making higher highs and higher lows? Downtrend. Lower highs and lower lows? Uptrend. Do not fight the daily trend, ever, especially during recovery. The daily trend is the river. You do not swim against the river when you're trying to rebuild. On the 4-hour chart, identify the key structural levels, previous swing highs, previous swing lows, areas where price has reacted multiple times. These are your trade zones, areas where you will look for entries. The confirmation time frame, 1 hour. Once the 4-hour shows price approaching a key level, drop to the 1 hour for confirmation. What you're looking for on the 1 hour is simple: a clear rejection of the level, a strong candle closing away from the zone, a break of the most recent 1 hour structure in your trade direction. All three together? High probability entry. 2 out of 3? Proceed with caution. Reduce size slightly. 1 or 0? Leave it. Move on. Next setup, the entry time frame, 15-minute. Once confirmed on the 1 hour, use the 15-minute chart to fine-tune your entry. Fine-tuning your entry is not about catching the absolute perfect price. It's about getting a better risk to reward ratio. A better entry means a tighter stop loss. A tighter stop loss means better risk to reward. Better risk to reward means you need fewer winning trades to be profitable. That is the mathematical advantage of multi-timeframe analysis. One chart gives you direction. One chart gives you confirmation. One chart gives you entry precision. 3 charts, 3 jobs. No overlap. No confusion. During April's 3rd week, you are not just trading technicals. You are trading in an environment loaded with fundamental catalysts. Understanding what is on the calendar and when it drops is not optional knowledge. It is survival knowledge. Trading blind through major news events during a recovery phase is how you turn a rebuilding account into a blown account. Here is what the calendar typically carries during April's 3rd week and what each event means for your positions. Purchasing Managers Index data, PMI. PMI reports from the United States, European Union, and United Kingdom all typically released during this window. PMI data shows whether the manufacturing and services sectors are expanding or contracting. Above 50 means expansion. Below 50 means contraction. Post-war PMI data is particularly powerful because it shows whether the economy absorbed the conflict shock or is genuinely deteriorating. A US PMI above expectations during this week, dollar strengthens. USD/J, PY pushes higher. EUR/USD faces pressure. A European PMI beat, Euro gets a bid. EUR/USD potential upside. EUR/GBP movement. Know when these release. Be out of open trades 30 minutes before, or have stops set wide enough to survive the spike. US retail sales data. This release typically falls during the 3rd week of April. It is one of the most market-moving data points for the dollar. Retail sales measure consumer spending. Consumer spending is 70% of the US economy. Strong retail sales post-war =sign US economy is resilient =sign Fed, can maintain rates =sign dollar strength. Weak retail sales post-war =sign war impact, hitting the consumer =sign Fed may need to cut sooner =sign dollar weakness. Know which direction retail sales beat or miss. Then look at how dollar pairs react in the hour after release. That reaction tells you the real institutional sentiment. Weekly jobless claims. Every Thursday. This is a weekly release, but it carries extra weight right now. Why? because rising jobless claims during post-war stabilization would signal the conflict caused real economic damage. That changes the Fed narrative completely. Watch Thursday's release carefully. Claims rising above 250,000. Dollar could face selling pressure. Risk pairs could bounce harder. Claims holding below 220,000. U.S. labor market is strong. Dollar support remains. Commodity pairs face headwinds. Federal Reserve officials' speeches. April's third week almost always carries multiple Fed speaker events. Sometimes 4 or 5 different officials speaking across the week. Every single speech is a clue. Listen for key phrases. We are monitoring conditions means uncertainty. We remain committed to our target means rates staying higher. We see progress means cuts might be coming sooner. These phrases move Forex more than any technical level. Schedule these speeches in your trading calendar. Treat them like live news events. Be positioned before they start or be flat and watching. The overall calendar rule. No open trades without stops during major news releases. No exceptions. Either set your stop and let it ride through the data, or close the trade before the release and re-enter after the dust settles. The second approach is safer for recovering traders. Let the volatility happen, then trade the confirmed direction after. War creates chaos in price. Levels that held for months get broken. Ranges that were established over years get violated overnight. Some of those breaks are real, genuine trend changes driven by fundamental shifts. Some of those breaks are false, institutional liquidity grabs that reversed hard after clearing retail stop losses. Knowing which is which during April's third week is the technical edge that determines recovery success. Here is the methodology for identifying and using the key levels right now. The return to pre-war levels. The first thing to understand is where price was before the conflict escalated. Mark that level on your chart. These pre-war price zones are significant because they represent the market's last rational consensus before fear took over. As fear unwinds, price often attempts to return to these zones, sometimes quickly, sometimes slowly. But the gravitational pull toward pre-war pricing is real. When price reaches a pre-war level, watch the reaction carefully. Strong rejection. Institutional sellers are defending that level. It remains resistance. Clean break and hold. Buyers are absorbing the selling. The level is flipping from resistance to support. New upside potential opens. The war low and war high zones. During the conflict, price created extreme points. A war low where peak fear drove currencies to irrational levels, and a war high where safe haven buying pushed certain currencies above fair value. Mark both of these zones. These are the most important levels on your chart right now. The war low is a potential demand zone. If price returns to it during the recovery, that is where the strongest buying interest will emerge. Big institutions who missed the initial move will add positions there. The war high is a supply zone, where safe haven buying peaked. If price rallies back to that level, expect significant selling pressure. Between these two extremes is where the recovery trade lives. The 50% Fibonacci retracement. Take the entire war move from the pre-conflict price to either the war high or war low. Draw a Fibonacci retracement. The 50% level is your key focus. Markets have a mechanical tendency to retrace 50% of major moves before continuing. This is not mystical. It is mathematical. It reflects the natural balance between buyers and sellers as extreme moves normalize. During April's third week, the 50% retracement zones on war-affected pairs are active targets. If you're long, target the 50% retracement of the downward war move as your first profit target. If you're short, target the 50% retracement of the upward war spike as your first profit target. Volume profile levels. If your platform supports volume profile analysis, look for the high volume nodes from the weeks before the war started. High volume nodes represent price areas where the most trading activity occurred. These areas represent consensus, fair value. Post-war, price gravitates back to these high-volume areas. They act as magnets during the stabilization phase. Your entries near high-volume nodes, with confluence from the other levels mentioned above, those are your highest probability trades this week. Everything covered so far is mechanical, structural, analytical, but none of it works if your psychological operating system is broken, and after significant losses from war-related volatility, it is broken. Almost certainly. Not because you are weak, because that is how the human brain responds to financial loss. It is biology, not weakness. Understanding exactly what is happening in your brain right now and how to rewire it deliberately. That is what determines if you execute the recovery plan or self-sabotage it. Here is what is currently happening in your psychological state after the war losses. Loss aversion elevation. Research in behavioral finance shows that losses feel approximately twice as painful as equivalent gains feel positive. Losing $1,000 creates twice the emotional impact of gaining $1,000. After significant war losses, your loss aversion is not at the normal 2 times level. It is elevated. Much higher. This means every losing trade during the recovery phase will feel catastrophic, even if it is a properly sized 2% loss following all the rules. Your brain will interpret a small controlled loss as evidence that recovery is impossible. That will cause you to either stop trading prematurely or increase size trying to get it back. Both destroy the recovery. The solution is awareness. Know this is happening. Name it when it happens. This is elevated loss aversion reacting to a normal controlled loss. Then follow the plan anyway. Decision fatigue. During the war volatility, you made many reactive decisions under stress. Your decision-making capacity is depleted. A depleted decision maker makes poor choices, takes low-quality setups, ignores risk management rules, trades emotionally. The solution is strict routine. Set your trading hours. Outside those hours, the platform is closed. No exceptions. Within those hours, only follow the predefined checklist for entry confirmation. No discretionary decisions. No gut-feeling trades. The checklist eliminates decision fatigue from the equation. Recency bias. After a traumatic market event, your brain overweights recent events when predicting the future. You start expecting the war-level volatility to continue. You start expecting every trade to fail. You start seeing danger in setups that are actually clean. Counter recency bias by studying pre-war data. Look at how your pairs behave during similar post-conflict stabilization periods historically. Ground your expectations in data, not recent memory. The 3-sentence trade rule. Before clicking any trade this week, write down 3 sentences. Sentence 1. The direction of the daily trend on this pair. Sentence 2. The key level at price is reacting to. Sentence 3. My exact entry trigger, stop loss level, and target. If you cannot write all 3 clearly and quickly, you do not have a trade. You have a feeling, and feelings do not belong in a recovery trading plan. This rule alone will eliminate the majority of bad trades that recovering traders take. Everything in this video has been building to this point. You now have the context. You have the pairs. You have the position sizing. You have the time frame structure. You have the calendar. You have the key levels. You have the psychological framework. Now you need the actual execution plan. The daily operating procedure for this week. Here's exactly how each trading day of April's 3rd week should look. Pre-session routine. Before markets open. Check the economic calendar for the day. Identify every scheduled news release. Mark the exact times. Open the daily chart for each focus pair. Identify if price is above or below the key pre-war levels. Note the daily trend direction. Open the 4-hour chart. Identify the nearest key structural levels above and below current price. Set price alerts at those key levels. These alerts will notify you when price is approaching a tradable zone. You do not need to stare at the screen waiting. Write down the maximum number of trades you will take today. 2 is the maximum during the recovery phase. 2 quality trades, not 6 mediocre ones. During session. Active market hours. When a price alert triggers, open the 1-hour chart. Confirm the reaction. Is there a rejection forming? Is there a break of structure? If yes, move to 15-minute for entry refinement. If the setup meets all 3 checklist criteria, calculate position size using the 2% formula. Set the stop loss. Set the take profit. Enter. Then step back. The trade is on. The plan is set. You do not need to manage it every minute. Check once per hour at maximum, not more. Post-session review. After markets close. Review every trade taken that day. Not based on profit or loss. Based on process quality. Did you follow the checklist? Yes or no? Did you respect the 2% limit? Yes or no? Did you exit before major news releases? Yes or no? Process quality is the only metric that matters during recovery, not daily profit or loss. If you followed the process correctly, a losing day is a good day. You did everything right. The market just didn't cooperate. If you did not follow the process, a winning day is a bad day. You got lucky and luck runs out. Track process, not profit. During recovery, every single day. The weekly review. End of April's 3rd week. At the end of the week, review the total result, not just financially, holistically. How many trades followed the checklist completely? What percentage? What was the average risk to reward ratio achieved? Which pairs performed as expected? Which didn't, and why? What needs to be adjusted going into the following week? This review is your feedback loop. Without it, you are flying blind. With it, you are building a systematic understanding of what works in post-war conditions. That systematic understanding is what compounds over time into consistent profitability. April's third week is the starting line of your recovery. Not the finish line. The starting line. The recovery itself will take months. Not days, not weeks. Months. But starting correctly, with the right pairs, the right size, the right time frame, the right psychological framework, and the right daily process, that determines everything that follows. You cannot control the market. You cannot control what the news says. You cannot control if the next trade wins or loses. You can control every single thing covered in this video. Control what you can control. Execute with discipline. Give it time. That is the complete formula. Now close this video. Open your charts and start building.